Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at UiPath.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we jump into today's stock, here is a really useful chart tool for you. If you want some help reading trading charts more clearly, you can check out VIP Algos. The link is below in the description. It is basically a TradingView indicator suite.
Right.
Yeah, it shows you visual buy and sell chart alerts, trend direction tools, support and resistance zones, and areas for take profit and stop loss planning. You can use it across a ton of markets, like stocks, Forex, crypto, gold, futures, all of that.
They're nice.
But just remember, VIP Algos is strictly an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it guarantees no profits.
Yeah, trading always involves risk.
Exactly. So always manage your risk and do your own research. And just a heads up, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, so imagine a company that just crossed its first ever major profitability milestone. I mean, they are sitting on an absolute mountain of cash, like $1.4 billion to be exact.
Wow, that's huge.
It is. And with absolutely zero debt, by every strict accounting measure, they are fundamentally turning this massive corner. And yet, Wall Street has just aggressively punished the stock.
Yeah, sending it down, what, 35% this year?
Exactly, down 35%. I mean, it is heavily shorted, completely out of favor with analysts, and honestly, it's trading like a company on the verge of bankruptcy. So today, we are figuring out who is fundamentally wrong here. Is it the balance sheet or is it the market?
That disconnect is exactly why this setup is so fascinating right now. You are looking at a classic tension between the underlying business momentum and, well, the equity pricing.
Right.
Because when a stock chart looks like it has been put through a blender, but the actual company is printing money, it creates a very specific kind of opportunity for an observant investor.
All right, let's move into the wealth building context. To understand if that opportunity is real or if it's just, a value trap, we really need to understand what this company actually does. Because historically, they are known for RPA, which is robotic process automation.
Yeah, and we should probably clarify what RPA actually is for anyone newer to this. In the past, it essentially meant training software to be a digital parrot.
A digital parrot. I like that.
Right. Like if a human employee copies data from a PDF, opens up an Excel spreadsheet, pastes it into a cell, and clicks save, an RPA bot was built to just mimic those exact keystrokes just over and over again.
Super useful, but rigid.
Incredibly useful, but yeah, very rigid. Because if the PDF formatting changed even slightly, the bot would totally break.
And this is where I have to play the skeptic.
Right.
Because their entire new thesis is that they're moving away from basic RPA. They claim they're transitioning into the definitive orchestration layer for enterprise AI.
It's a bold claim.
And my alarm bells are immediately ringing. AI orchestration sounds exactly like something a marketing team just invented to sell more software during a hype cycle. I mean, every tech pitch deck on earth has the letters A, and I slapped on it right now. What does that actually mean for a business's bottom line? Like, is this just upgrading from a factory robot that does one repetitive task to a floor manager that coordinates the entire supply chain?
Okay, well, that's a totally fair pushback. But let's ground it in reality because your floor manager analogy is actually spot on. The transition from RPA to AI orchestration is kind of like the difference between buying a basic spell checker and hiring an editor-in-chief.
Oh, okay. So the basic RPA just fixes the typos you point at. It just does the manual labor you tell it to do.
Exactly.
But the AI orchestration, the editor-in-chief, actually reads the text, understands the context, and decides what the entire book should be about. It directs the logic.
Yes, perfectly said. This isn't just about clicking buttons anymore. Imagine a massive global bank. They have legacy mainframe databases from the 1990s, plus modern cloud servers, plus customer relationship management software.
And none of them naturally talk to each other.
Exactly. An AI orchestrator acts as the central brain. So it gets an email from a customer, uses a language model to actually read and understand that they want to dispute a charge, securely pulls the transaction data from the old mainframe, cross-references it with fraud detection algorithms, and automatically resolves the dispute in the CRM.
Without a human ever touching it.
Without a human ever touching it.
Which completely validates why this is transitioning from a neat software patch into a long-term necessity. I mean, saving a few hours of data entry was a luxury. But autonomously managing complex multi-step workflows across an entire global enterprise, that is becoming mandatory infrastructure.
That gives us the bigger picture. Now let's look at the fundamentals, because the numbers are really what signal that they're successfully making this transition. Let's look at the actual accounting.
What are the numbers saying?
In Q1 of fiscal year 2027, they delivered a landmark, first-ever GAAP operating profit of $28 million.
We have to underline the word gap there for a second. Generally accepted accounting principles.
Yep.
For the last decade, software companies have loved to boast about adjusted profitability. They'd say, look, we're profitable. As long as you ignore the hundreds of millions of dollars in stock-based compensation we're handing out.
Right, the smoke and mirrors.
Exactly.
Yeah.
GAAP operating profit strips all of that away. It means they're actually in the green by the strictest accounting standards in the world.
It proves the business model actually works. And the top line is accelerating right alongside it. Revenue reached $418 million, which is 17% year-over-year growth. And their annual recurring revenue ARR, the absolute lifeblood of software companies, is up to an incredibly impressive $1.901 billion.
Almost $2 billion in recurring revenue. So they definitely have the scale. But what do the margins look like? Because scale without margins is basically just a charity.
The margins are exceptional. They are posting gross margins between 82 and 83%.
Wow. If you are managing your own portfolio, you really need to internalize what an 83% gross margin means. It represents massive operating leverage. For every new dollar of revenue that comes in the door, 83 cents is pure gross profit.
Because they've already paid for the software development.
Right. They already built the infrastructure. So once they clear those fixed costs, the vast majority of that revenue falls straight to the bottom line. It is a cash machine.
Which brings us directly to their balance sheet. It is a fortress. They were sitting on $1.42 billion in cash, cash equivalents, and marketable securities.
And what's the debt load looking like to offset all that cash?
Zero debt. Absolutely none. Plus, they're generating robust cash flow. They brought in $130 million in free cash flow just in the quarter.
Let that sink in for a minute. You have a tech stock down 35% on the year, treated like a toxic asset, but it's sitting on $1.4 billion in cash, has zero debt, and is generating positive free cash flow. That downside cushion is massive. But, numbers on a spreadsheet don't protect you from competitors. Where is the actual moat defending this cash flow?
The moat is the product expansion we just touched on, specifically a new complex workflow tool called MaestroCase. Remember the editor-in-chief analogy?
Yeah, the brain of the operation.
Exactly. MaestroCase is the platform where that editing happens. And the proof that enterprise clients are desperately employing it is staggering. AI was included in 16 of their top 20 deals booked in Q1.
Okay, and how does adding AI into the mix impact the actual size of the contracts they're signing?
Those AI-inclusive deals were 6 times larger than their non-AI deals.
6 times the revenue footprint. That's huge.
And their overall dollar-based net retention rate is 109%, which basically tells us existing customers are not just staying, they are spending more money on the platform year over year.
Okay, I hear the 83% margins, I see the $1.4 billion in cash, and I understand the massive 6x deal expansion. But as an investor, you always have to look for the leak in the bucket. What is the catch here?
There's always a catch.
Right, because when I look at the data, their net new annual recurring revenue was only $49 million for the quarter. That figure seems incredibly modest compared to the massive revenue beats and the $1.9 billion total ARR. If the whales are signing these massive contracts, why is the new growth lagging so heavily?
That is the exact pressure point that triggered the 35% sell-off. And it's something we are going to dig into deeply when we get to the bear case and risks. But before we get to why it's dropping, we need to understand what could make it rise.
Right.
So they have this massive enterprise moat and a fortress balance sheet, but none of that matters to the stock price unless there's a spark to wake up the market. What actually forces Wall Street to reprice the stock in the near future?
That gives us the business picture.
Yeah.
Now let's move to the catalyst timeline. You need clear markers on the roadmap. What are we looking at?
Well, the most immediate major catalyst event is the September 8, 2026 earnings report.
And going into that September 8th call, what is the street demanding to see?
Sustained execution. The market needs to see that the GAAP profitability wasn't just like a one-time accounting fluke. And crucially, they need to show that ARR is accelerating, specifically driven by the adoption of these complex MaestroCase AI workflows.
But earnings are just a snapshot in time. What's the ongoing operational catalyst that continues driving the business forward, regardless of what quarter we're in?
It all comes back to the real-world utility of MaestroCase. To give you a specific visceral data point on why this matters, look at one of their clients, 1NZ. They're a major telecom operator.
Okay.
They integrated MeisterCase to handle their mobile provisioning process. And previously, this took them 10 days to complete.
Let's break down what mobile provisioning actually means, because it sounds like dry telecom jargon. Provisioning is the entire process of setting up a customer on the network. It means allocating bandwidth, registering SIM cards across multiple legacy servers, setting up the billing profile, activating the service. When that takes 10 days, you are talking about 10 days of lost revenue, massive human error, frustrated customers calling support lines, and bloated operational overhead.
Exactly. It's a nightmare. And by deploying MeisterCase, 1NZ cut that 10-day process down to under 10 minutes.
Wait, 10 days down to 10 minutes.
Under 10 minutes.
I really want you to ponder that for a second. If a company can compress 240 hours of friction down to a 10-minute automated task, how long does that software remain an optional luxury?
It doesn't.
It immediately becomes a survival mechanism against competitors who are operating at that speed. If your rival provisions a customer in 10 minutes while you take 10 days, you will go out of business.
Precisely. That is the ultimate product catalyst. But beyond the company-specific drivers, we also have to factor in the macro environment. We're looking at a landscape with potential interest rate cuts on the horizon.
Which is huge for tech.
Exactly. Historically, lower rates reduce the discount rate applied to future earnings. That dynamic disproportionately benefits high-growth software equities, lifting their valuations. Combine that with a broader sector rotation where enterprises are moving past AI hype and finally figuring out how to deploy AI practically, and you have massive tailwinds.
So the fundamental catalysts tell us what could fundamentally change the story. Wall Street eventually prices in that reality. But what is the chart telling us today?
Catalysts tell us what could change the story. Now let's pivot to the chart. Looking at the technicals, the stock has recently been trading right around $10.87. This comes after a notable pullback from a recent high of $13.20.
So it retreated, but where is it actually finding buyers? Where's the support?
If you look at the 4-hour chart, it has established strong support right along an ascending trend line. And if we evaluate the momentum using the Relative Strength Index, the RSI, it's currently sitting at 64.33.
For anyone who doesn't stare at charts all day, an RSI of 64.33 means the momentum is essentially neutral to bullish. The stock has strength behind it, buyers are stepping in, but it hasn't crossed into that technically overbought territory yet, which usually happens above 70.
Right.
So there's still room for it to run before it hits an extreme level where sellers might naturally step in to take profits.
Exactly. And as it runs, there are key technical resistance targets layered between $12 and $17. But the immediate trigger zone to watch is $11.90. If the price can break and hold above that $11.07, it confirms a breakout that could trigger an extension to the next resistance zone around $12.60.
But on the downside, there is a massive structural floor resting at $9.63. We're going to talk about exactly why that specific price is so incredibly important in a moment, because it ties directly into some major insider action. But first, I have to point out the extreme volatility here.
It's intense.
It is. Because of the heavy short interest, we're seeing wild intraday swings. The stock is suddenly popping up to 8% on incredibly heavy volume out of nowhere.
It is an incredibly turbulent chart to navigate.
Which is exactly why traders who play in these volatile arenas use tools like VIP Algos. When a stock is violently swinging 8% intraday, you do not want to be guessing where those structural floors and ceilings are. You want that trend direction and those support zones mapped visually on your screen so you can actually plan your entry and exit points. Again, not telling you what to trade, but the visual mapping helps.
So the chart gives us the price structure and the volatility, but who is actually doing the buying and selling? What does the market sentiment look like?
So the chart gives us price structure. But what does market sentiment look like? This is where the story gets really fascinating, because there is a massive divergence in sentiment right now. You have Wall Street analysts standing on one side of the room, and the actual corporate insiders standing on the exact opposite side.
Wall Street is currently playing it very cautious. For example, UBS recently lowered its price target on the stock to $12 while maintaining a neutral rating.
The analysts are covering their bases, cutting targets, playing it safe. But what are the insiders doing? The people who actually see the daily operational data.
The insiders and institutional investors are heavily accumulating shares. And the ultimate proof of that bullish internal sentiment arrived right after the latest earnings release. The board of directors executed a massive 10b5-1 buyback program.
For context, a 10b5-1 plan is a pre-scheduled, legally binding contract for insiders to buy or sell stock. It essentially prevents accusations of insider trading because the execution dates and prices are set in advance. So they locked in a plan to buy. How aggressive was it?
Incredibly aggressive. They repurchased 22 million shares.
It's only 2 million.
Yep. And included in that massive buyback was a block of 2 million shares purchased right at that $9.63 level.
Which perfectly explains why $9.63 has become such an impenetrable structural floor on the technical chart. If the board of directors is literally backing up the truck to buy millions of their own shares at $9.63, it sends a blaring signal to the entire market. Management is flat out telling Wall Street that they believe the stock is deeply undervalued at that price.
It also fuels quite a bit of speculative sentiment in the market.
Right, because whenever you combine massive insider buybacks that reduce the available float of shares with incredibly high short interest, the rumors inevitably start flying about a potential short squeeze.
Can you explain the mechanics of that for the listener, just how a squeeze works?
Absolutely. When a hedge fund shorts a stock, they are borrowing shares and selling them, betting the price will drop so they can buy them back cheaper later. But if the board is aggressively buying up 22 million shares, they are shrinking the pool of available stock.
So supply drops.
Exactly. If the price starts to tick up unexpectedly, those short sellers start losing money. To stop the bleeding, they have to buy back the stock to cover their positions. That forced buying shoots the price up even faster, which forces more shorts to cover, creating a violent upward spiral. That's a short squeeze.
But we really have to temper expectations there.
We do. A short squeeze is a rumor. It is a highly speculative, fragile setup. It might happen or it might fizzle out completely. But the board of directors utilizing their fortress balance sheet to buy 22 million shares, that is a hard fact. We analyze and invest based on facts, not internet rumors.
That sentiment picture is useful, but we still need to talk about the risks.
Right.
The downside reality is that the stock did slide 35% year-to-date, and the market wasn't just throwing a tantrum. There is a legitimate fundamental concern, which we touched on earlier, the lagging net new ARR.
Right, that paltry $49 million figure for the quarter. Where exactly is the leak in the bucket?
The research clearly shows this lag is primarily being driven by severe churn in their smaller customer segment. Specifically, customers generating sub-$30,000 in annual recurring revenue.
So the small businesses are abandoning the platform in droves. If you are holding this stock, you have to ask yourself a critical question. Does this churn signal a fundamental flaw in the product? Like, is the transition to AI orchestration making the software too incredibly complex and expensive for normal, everyday businesses to use? Or is the company just deliberately pivoting its sales force to exclusively hunt the big global enterprise whales?
Well, based on the data, it appears to be a deliberate pivot. They are hyper-focusing their resources on complex AI orchestration, which naturally caters to massive global enterprises. The exact clients that can sign those 6x deal expansions, they are sacrificing the minnows to catch the whales.
Makes sense strategically.
It does. But regardless of the strategy, losing that sheer volume of smaller customers acts as a heavy drag on the net new ARR numbers in the short term, and the market hates that kind of drag.
There is also significant execution risk to consider. Transitioning an entire corporate identity from basic RPA automation to complex AI orchestration is an incredibly heavy lift. It is not a guaranteed success. And as an investor, you simply cannot ignore the unpredictable price swings. The high short interest creates vicious volatility that can easily shake out nervous hands.
It is a bumpy ride. But again, you have to weigh that against the fact that they have $1.4 billion in cash and zero debt. That provides a hefty downside cushion. They are not going bankrupt tomorrow.
So with everything on the table, what's the final verdict? We have the $1.4 billion cash cushion and the 6x enterprise deal expansions on one side, and the massive sub-30K customer churn and heavy short interest on the other.
Based purely on the fundamental shift in their business model and the massive internal accumulation, the final stance is a bullish score of 8 out of 10.
An 8 out of 10. And what does the time horizon look like for that rating?
It effectively works on 2 different time frames. It sets up as a very compelling short-term swing trade heading into that upcoming September 8 earnings catalyst, but it also works as a multi-year long-term hold based on the broader enterprise adoption of the Maestro case platform.
Just to recap the core drivers for everyone listening, the main upside driver here is that incredibly powerful metric deal expansions are 6 times larger when AI is included.
While the main risk remains the continued churn we are seeing in the sub-$30 ARR customer segment.
If you are looking at this for your own portfolio, you have to determine your personal fit. This setup really suits an investor who is looking for a high-quality, cash-rich turnaround play. But I have to give a strong word of caution. Ask yourself what your tolerance for pain is. If you are afraid of short-term volatility, you need to be very careful here. Those 8% intraday swings we talked about are not for the faint of heart.
Definitely not.
And of course, it is crucial to remember that this entire analysis is for educational purposes and is not financial advice. You should never buy, sell, or hold any security based solely on our discussion today. Always do your own due diligence and manage your own risk.
Absolutely.
And if you want a cleaner way to read those volatile trading charts we discussed, make sure to check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can certainly help make charts easier to scan, but remember it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk appropriately. Again, this is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
As you look at the broader market tomorrow, I want you to ask yourself this. When a company proves it can turn a 10-day operational nightmare into a 10-minute automated task, how long until the rest of the world realizes that they aren't just selling software, they're selling a survival tactic?